Hello, welcome to Equity Merchants on Business Front TV, the show where we follow the money shaping Africa's tech, finance, and energy markets. I'm Chimgoslu, coming to you from Lagos, Nigeria. Here are the money moves we are tracking. Jumia loses oldest investor. Lending rates fall in Kenya as NSE plans to democratize stock investing. Kasada secures 90 million euros for Senegalese hospitality investment. Access Bank completes National Bank of Kenya acquisition. It's been a busy few weeks for Jumia. After announcing a decline in revenue in its Q1 2025 results, it saw Bailey Gifford, one of its oldest investors, dump its shares. However, it also welcomed a new investor in telecommunications service provider Axian Telecoms. Average lending rates across commercial banks in Kenya have declined to 15.65%, the lowest level since January 2024. This decrease follows a series of rate cuts initiated by the Central Bank of Kenya earlier this year. Meanwhile, efforts to open the Nairobi Securities Exchange to retail investors are encountering resistance from stockbrokers who fear the changes could marginalize their role in the market. Kasada, a real estate private equity platform, has secured 19.4 million euros in sustainability-linked financing from Nedbank Corporate and Investment Banking. The funds will support the development of the Movenpick Resort Lamantin Sali in Senegal. This marks a key step in Kasada's commitment to sustainable hospitality, aligning its investment strategy with environmental and community impact goals. Access Bank has completed its acquisition of the National Bank of Kenya from KCB Group, boosting its presence in East Africa. The $102 million deal expands Access Bank's branch network and market share in Kenya, elevating it to a Tier 2 bank. Access Bank's cross-border push is a reminder that deep pockets still find deals. But for startups, the capital mix is shifting. And that brings us to today's big talking point. Across the continent, more founders are swapping equity for debt. Why? Smaller checks, faster closes, and fewer dilution headaches, at least on paper. One company living this story is Sycamore. In 2024, Sycamore, a Nigerian fintech startup, disbursed over $5 million in loans and grew its revenue past $1 million. Originally launched as a peer-to-peer lender, Sycamore has since expanded its offerings to include investments, savings, and payments. Today on Business Front TV, we are joined by Babatunde Akinmoses, CEO of Sycamore, to talk about the company's latest push for funding and its outlook on the evolving fintech landscape. Babatunde, welcome to Business Front TV.
Good to be here.
Awesome. So we are seeing more African startups switch to debt as an alternative to equity. In your view, what do you think is driving this shift, and what are some local factors, especially locally, that are encouraging startups to go after debt?
Right. So I think people are turning more to debt now, particularly in Nigeria and Africa, because of at least three reasons, right? The first is the whole currency devaluation thing. Taking investment in debt reduces your obligation to pay because it doesn't have an exponential upside, right? So you take $1 million, you want to pay 10x, that's $10 million at whatever exchange rate it is, as opposed to living in, let's say, $1.2 million, for instance. Even if you're still dealing with the exchange rate devaluation, at least it's limited from that perspective. Two is where we are now in terms of we've gone past the zero interest rate season, right, where capital was awash, and from the West, and there was a lot of equity fundraising in 2021, 2022. Okay. But that season is over, or at least stalled for now. There's a lot of talk about unit economics, revenue and profits, now. So it's much more difficult to raise equity now. And last but not least, debt is even in the conversation now because there is financial history. A lot of startups are now 5 years old, if you can still call them startups. Somebody was joking that if you are 10 years old, I used to say startup. But if you are 10 years old, you have history, you have numbers, you have financials, you can actually talk about debt, right? So one of the things about debt is you need records. You need to see your cash flow. You need to see what you've done, right? When somebody starts a business, debt is not typically even in the conversation because they're going to ask you, where's your last maybe 3 years financial statements? As a new company, you don't have that. So I think some companies have also come of age now, some startups to say, oh, now you can actually ask for debt because you have history. You're no longer fresh from your living room or your garage as they do it in the US. Yeah.
Okay. So Sycamore recently received 1.5 billion naira in debt from Cascador, but you're still in the market for more.
Yes.
Can you give me a sense of how demand for your loan products or just your general product at Sycamore has evolved over the last 6 years?
Yeah. So, I mean, the truth is there's always been a lot of demand for credit. And people joke that if you bring 10 trillion, what am I saying, 100 trillion naira or dollars, any currency, and you drop it in the middle of Balogun market, there will be people that will take it, right? It's a question of risk. So there's always been that demand. I think one of the maybe few changes we've seen is people are embracing debt more as there's more financial awareness of a lot of finance influencers on TikTok and Instagram and social media talking about money generally. So people understand that debt is not a taboo, God forbid, type of thing. And then the demand for it has also, the amounts requested have almost increased, right? Also increased rather. And that's because you have what has happened in the last few years. So I remember as at 2020, $20,000 was 7.2 million naira, right? So, I mean, you can do the math. $20,000 is, you can still, I mean, there's inflation, but in the US, probably not too much difference in what you could have gotten between then and now. But now, $20,000 is almost it's over 30 million naira now, right? So people are asking for higher amounts because they are buying the same things, but the naira has depreciated. So there's more of that sort of demand for higher ticket loans. So generally, in naira terms, that demand has even increased, coupled with the fact that people are embracing debt more. Then you look at the purchasing power that has reduced with the value of the currency depreciated. So people are asking for more quality, they're asking for more quantity. So there's really just been an upsurge of demand in the last few years for credit, generally speaking. Yeah.
Okay. So you've been lending for a very long time now, 6 years now.
Yeah.
And like you mentioned, the major thing here is risk.
Yes,
and in Nigeria, it's just common that lending is easy, but getting your money back is very difficult. What has your experience been like at Sycamore? And what are some of your risk frameworks that help?
So in terms of our approach to risk management, what we've tried to do is balance speed and accuracy, right? I think some traditional institutions would want to, they can give you, even if you ask for 100 billion, they might be able to give it to you, but how long will it take? Do you still need it by the time it's ready, right? And other fintechs can give you now, but they might not be able to give you the amount you want. Maybe they'll say, oh, we'll start you with 10,000 naira or 20,000 naira. So you really want to balance that speed and that accuracy. And one of the things we're trying to do is, or we've tried to always do, is balance speed without giving out a bad loan. So ask for some information and using as much technology application as possible. So it's not like we're asking you to go and bring what your grandmother buried in her kitchen 3 years ago, right? So it's always that unbalance. And I was even saying it to somebody about lenders typically would have bad or very poor rating on Play Store or App Store because people just feel, oh, you decline them and they're upset. I'll give you 1 star, even if they don't qualify for the loan, right? So at Sycamore, we're very big on KYC. We've always asked for certain things. So right from day one, we've been asking for BVN and NIN even before it became so popular. And if you recall, recently there was that thing in the news where FedEx were saying, oh, start getting KYC and BVN for your customers. We've always been doing that. Some other guys were even fined for also not verifying addresses. We've also always been doing that. So it's just really a lot more thorough KYC. So it's not just KYC on paper, it's KYC of actually knowing your customer. Where does it live? What do they do? Try and get information, and you want to make it as fast as possible, which is why I like to say we have a hybrid approach. There's technology, AI, machine learning, all the fancy things that everybody does. We do that as well, but we also would do it with the support of human intervention, just to make sure that we're balancing the risk and the convenience for the customer. So those are some of the things I think have helped us over time.
Okay, so speaking of balancing risk, Nigeria's open banking framework is supposed to go live sometime in August.
Yes.
Whether that happens is yet to be seen. But for you, what opportunities do you
Yeah.
think or do you see for Sycamore, and how are you preparing for those opportunities?
Yeah. So that's a very good question. So open banking opportunities, I think it's going to be subject to everybody's creativity, and also the extent to which
It is open.
it is open, and to the extent to which the commercial banks would even adopt it, right? So if if the banks do everything that the policy intends to achieve, right, a lot of people will be able to build products directly. Um, so things that will become easier to achieve for every fintech will be things like identity verification. Payments will be easier, direct debits will be easier because we're expecting common frameworks across the banks for their APIs to be written in the same standard, right? Again, we pray those standards will be adhered to. We pray that they will even be available to be adopted again the way the policy intends. So I think we're going to see a lot of more availability of information in terms of identity. We're going to see a lot done in terms of even payments as it applies across banks. Maybe two areas I'm also curious about to see how it will play out is because there's going to be so much data. One of the things that people like Mr. Deji Olowe, one of the people driving it, has said is, shouldn't people be able to make money from their data? So if you have my data now, 3 banks, and you've exposed it to 20 fintechs, and you're making money from that, shouldn't I, as the owner of the data, also be making money? I'm very curious to see if some people would actually champion that. You know, where's the money from my data that you guys are making money with? And then the second thing is, again, which I've also discussed with a lot of people, there are a lot of new banks now. People are using a lot of, I don't know if I'm allowed to mention names, Kuda, MoneyPoint, OPay. That's what some people bank with. What I'm not 100% sure is if there's any requirement for these guys to actually comply with open banking. Because at the time this journey started, the target was really the commercial banks. These guys hadn't dominated the space as much, right? Because right now, you don't really plug into those guys the way you plug into banks for several services. So I think that's a very interesting area that I hope would also be addressed. Does this apply to microfinance banks? Does it apply to MMOs who also hold custody of funds where a lot of people are keeping their money now? So I think that that extension of the banking definition to include microfinance banks and other entities that are custodian of funds, and even some fintechs too, where people have all their savings and investments now, that they are also valid source of data, and they're even bigger than some banks, right? So that's something I'm very curious to see how it plays out as well.
Okay, so back to Sycamore. You have focused on Nigeria so far.
Yes.
Do you have any plans to go beyond Nigeria anytime soon?
Yeah, we do actually. So I think something that we've seen, our plan initially was to go to other African countries, so East Africa, South Africa, but we are seeing that it might actually be more practical for us to actually just go to 3 other places now, UK, Canada, and US. Why? A lot of our customers have already relocated in the last 5 years. I don't think there's a Japa wave right now. I think the Japa wave happened between 2022 and 2023. But now with the devaluation, it's 2021, 2022 rather than half of 2023. But once the currency tripled, it was very prohibitive for a lot of people. So we have a lot of people that we've served over our 6 years of existence who have now moved, and we still like some of our services, right? But they are constrained where they are now because they have limited credit history. They're not taking loans where they are. We're talking to one of our customers that has relocated to the UK, and I don't think the person can buy an iPhone worth of £8,000 just because of their limited credit access there. So now the question is, you guys have my credit history in Nigeria. Shouldn't you consider me for a facility based on the fact that I've been with you guys for so amount of time? So we are actively working on that. We've actually had a pilot, but we are trying to make sure that all the regulatory requirements are fulfilled so that we don't do anything outside the confines of what we're allowed to do. So definitely, if having this conversation this time next year, we should be talking about how we are now in a few countries, hopefully.
Awesome. All right, so I think that's it. Thank you so much for joining us on Business Front TV. Insightful stuff. Yet, if you're an equity merchant eyeing debt, slow down. Venture debt is not a quick fix. Structure, covenants, and cash flow discipline can make or break a business. So we've brought a second voice, Patrick Igwe, FinTech Business Officer at FSDH Merchant Bank, to cut through what it means to raise debt or other alternative financing options. I just want to start with, I guess, a mindset that we have as Africans, one which is that debt is not such a great thing. It's changing now, but most of us see debt as something that you shouldn't take. And even business owners often find themselves reluctant to take debt. So when do you think it makes sense for a startup to begin to consider debt in either over equity or in addition to equity?
Okay. So I think that first, debt is not a bad thing, right? I think it's an African thing or a Nigerian thing, but it's actually a good thing because it gives your business the opportunity to delve into other things, right? Expand into other areas. So I think that the time that a startup should begin to look out for debt should be when it's about to expand its product into other regions. Could be globally, internationally, global, international, regional, whatever it is, right? Because you begin to see that if you were to use equity in that context, if you were to use equity, there's a limit to what equity can do when it comes to expansion. But debt, I look at it as a tool. It's actually a tool that you can use to groom or grow your business or take it to the next level. That's basically my take on it.
Okay. So beyond VC funding and maybe traditional bank loans, what are some other types of financing that early stage founders should be looking at for their business, and how can they match it or match them to their growth stage?
Okay. So early stage founders, I think that there are different types of debt. That's the first aspect to it. There are different types of debt. And for an early stage founder, you want to think of how to gain traction. Like your focus is on traction, your focus is on getting your product out there. And there are actually debt products that focus on helping you, helping your daily operations or helping your business carry out its daily operations. One that comes off the top of my head, invoice finance, right? It's actually an operational type of debt, right? In my own words. So invoice finance, let me just sort of break that down a bit. As the name implies, you give me an invoice, right? And as the financier, I finance off that invoice, right? And I think that that's a very important tool, especially for businesses that are, their daily operations has to do with maybe trading, maybe basically trade-like sort of businesses, right? So I think that that's a very important tool. Aside from invoice financing, I think I mentioned somewhere about contract financing. I also mentioned somewhere around the word coming to mind is what's the word coming to mind? We have term loans, but I would not really look at term loan as an alternative, because that means that you are looking to make swift payments, right? But I think that invoice financing is a good product within the financing space or financing industry to sort of help you as a startup, especially early stage, right? You're trying to get your product out there. It's a very good tool.
All right, so we've talked extensively about invoice financing and contract financing, but for startups that are not exactly engaged in trade or engaging in trade, what other financing options exist for them? So let's say the likes of a Paystack or a Chowdeck, what kind of financing options exist for them?
Okay, so let's use maybe a Chowdeck as an example. So for Chowdeck or for businesses, software as a product services, right, or businesses, I would say that typically they would not necessarily, there are businesses that necessarily do not need finance, but they just need to be able to, I would say, triple what they currently have in revenue,
Okay.
right? And we have products centered around, let's say, a fixed deposit, right, or a call deposit where you are earning interest, right, on the finance that you have brought in to, let's say, the bank or the finance institution, right? Now, if we were to narrow it down to what Chowdeck would need, right, I would say that it still applies to the sector of business that they are falling under, right? Chowdeck falls under the food production space, right? And again, that still falls, that Chowdeck itself falls under invoice financing because I feel like that's a product that they would definitely need. But in terms of growing your money, right, I would say things like treasury management, your FX, things like your how you've raised capital somewhere, right, or you've raised equity somewhere, and you're looking to just ensure that this money is kept safe and it is earning interest for you, right? We have things like money markets, right? We see in the finance space we would call it CMMF, right? We also have things like, and these are asset-based or asset management products that I think that startups can leverage to even grow their finance beyond products that would basically, or beyond debt financing products, right? CMMFs are very good. I would say fixed deposits are very good. Call deposits are very good. Before CBN came into the picture, right, there used to be a product called the USD Cashback. Basically, it's basically a product that allows founders or startups or businesses generally who have raised USD, right, place their money to be used to secure a facility or a credit facility with a bank. But CBN came in, and I mean, that's because, I mean, we're trying to grow the economy, right? It was like using the dollar to bet against the economy, right? So that sort of changed, right? That policy, there was a policy that sort of took that, swept that off as a product. Now you would hear things like Eurobonds to be used to secure a credit facility. So, but I think that generally, right, it depends on the sector of the business, right? If we are narrowing it down to Chowdeck, I would say, having looked at the model, having looked at how their growth trajectory has been, I think that they would need a product that helps them make more money while the product itself is generating money. And that's why I think that maybe a CMMF would be a very good fit. Even a seamless HR, if I were to just use that, they would need to fix some of those cash or funds that are laying idle, right, into a vehicle or a mechanism that can help them generate more money, right, till when they need to disburse those money. So I think it depends on the sector, depends on the product itself.
Okay. So I'm a founder. I'm just starting out my business today, and I hope to be able to be eligible for debt financing or just alternative forms of capital in the future. What are some practices I should be instituting today to ensure that when it's time, I am eligible for these financing options?
Okay. So I think that building a product from scratch, you tend to overlook structure. Most founders tend to overlook structure. And I mean, it's typical because, I mean, in the startup game, you have to move very fast, right? But at the beginning, I think that setting some certain structures in place, maybe if I were to bring it down, maybe having an accountant, as little as that is, right? Having an accountant or even beginning to keep your books in order, right, are things that I think founders should really, really look into, right? And I mean, we hear this a lot with legal advice and the rest. You might not have them on your books, like on your payroll, but it's typically good to have maybe as friends or have those kind of people, accountants, auditors, legal professionals. Have them as friends. They might not be on your payroll, but those kind of services, right, are really important when you are building your product from scratch. As good as back-end developers are, front-end developers are, we tend to overlook the aspect of the business that would scale you in the future, or that would help your business scale better in the future. And there are typical examples. I've seen so many examples, right, of founders who have come to me looking for debt financing, right, or any type of debt finance product. But yet, it's always a struggle when I see that they don't even have, they only have their bank statements, right? They only have their bank statement. And beyond that, you will begin to, as a financier, first thing that comes to my mind is, can I see your audited financials? Right? That's the first thing that comes to my mind. And I see some founders don't even have that. Right? So from the get-go, I think that having it's expensive. That's the honest truth. But it's an expense that would help you in the future, right? And I think you also have to look at the stage of your business, the growth rate. How fast are you scaling, right? When you have gotten to a particular stage, these things are important. Audited financials are important. Your bank statements important because it helps us see trends that your business has gone through, right? Cash flow, even having a cash flow projection to know where your business will be going to, maybe in the next 5 years, 7 years, also helps the financier make informed decision about your business, even if the business is not making the required profits. We can know. So I think that having a good auditor, in fact, is good.
It's crucial.
It's very, very good. You shouldn't overlook it because as a financier, that's the first thing that comes to the tip of my mouth. Who's your auditor? Yeah. It's expensive, but it's a needed.
Very important.
Yeah, it's very important. Yeah.
Okay, so what are trends you're seeing around startups seeking financing? Not just from the startup side, but also as a financier yourself. What are some trends you're seeing? Things that maybe competitors are doing, things you're doing, and things you're thinking of doing as well.
Okay. So obviously, right now, if we're just narrowing it down to the technology sector, right? One trend I have seen is, I think this was somewhere around 2023, 2024. I started seeing influx of businesses seeking loans, debts, right? So I'm saying that in the next maybe 2 to 3 years, I'm not saying equity is bad. I'm just saying that in the next 2 or 3 years, you will begin to see a gradual shift, right? From, especially for those who have grown to a certain level, those who have product market fit, especially, right? Startups who have established their product in the market, they begin to look out for that. And that growth, if I were to put it in numbers, I've seen a 35% shift, if not 40% shift, from founders seeking equity to debt because the ecosystem now has matured, right? In my own words, right? It has grown from the fear of, oh, we need just only equity. Even those early stage businesses now, even though for me it feels like it might be too early, too soon, right? The first thing that comes out from their mouth is, how can I get alternative finance? Alternative finance for me is debt finance, right? Equity, right, is good. It's very good for the business. But I think that there is a gradual shift now towards debt. And another trend that I see within I would not say the technology ecosystem, but within the business segment in general, is basically a shift from FX, foreign, let me not use the word FX, let me use the word foreign currency, right? There's a trend now in Nigeria that allows businesses hedge their foreign currencies. Okay. And you typically know that founders raise their equity in dollars, right? There's a trend that allows, and I mentioned it earlier about Coral Money Market, CMMF. There's a trend towards placing those funds in vehicles that allow them generate more funds or more capital for the business. At the end of the day, it helps the bottom line of the business, right? So founders now are beginning to understand that they can't just keep their equity or their dollars in a particular, or just keep it in the bank. It has to be generating something for you. And that's what I think those trends are, right? Founders now being efficient, smarter with how they manage their finances, right? Founders now looking at their books more, looking at the financial health of their business more, because now they know that there is no loose money out there, right, coming to save them, right? And that is why now we hardly see raises. I would call it's a luxury now, right, to see just anyone raise money, right? When you are raising money, they know that this business is going to scale. They know that this business already is scaling or already has potential to scale, right? Has done something in the market for scale. But now, unlike the past, you would see people or founders or startups just secure money, come out to the media, or we have raised so and so, but that's not the case now. And that's why you begin to see people now looking for alternatives. So it's a shift. It was slow, but it's a shift that I noticed over the course of the years.
All right. Thank you so much, Patrick. Our startup funding trend today shows a wider dilemma. Thousands of African businesses sit in a missing middle. They've outgrown microloans and angel checks, yet they are still too small for the multinationals and big ticket funds that chase mega deals. You know the second M in MSME. It's easy to solve for micro and small scale, but how do you solve for medium-sized businesses or companies sitting just above that? How do we finance this overlooked engine room of the economy? To explore real solutions, I'm joined by Timothy Amos, Business Banking Officer at FSDH Merchant Bank. Timothy, welcome to Business Front TV.
My pleasure.
Awesome. So, from your perspective as a lender, why is it considered risky or unprofitable to lend to the missing middle?
Okay, that's an interesting question. So, there are three critical factors I'll speak to. First of all, as a lender, it's critical that we understand that the key factor, one, we want to lend to a business that is structured and have a very good credit score, and that the business in itself is kind of a bit stable. So we want to be certain that a customer is able to repay, make necessary repayment, has the adequate cash flow, and is able to some extent, we see that the customer is able to do all the necessary due diligence. Now, the 5 C's of credit, we talk about character, capacity. So we look out for all of these factors, and we ensure a client is credit ready. So most times we see that most SMEs, in fact MSMEs, I would say, their businesses are not that structured. Their businesses do not have the necessary requirement and the cash flow for the credit facility they are requiring. And it's usually challenging from a lender's perspective. So we want to be able to see that this customer have the history and the capacity to make the necessary repayment. So that has been the challenge in the MSME sector.
Okay. So what are some challenges you face when you're evaluating creditworthiness? I mean, you've already spoken to structure.
Yeah.
Let's go beyond structure. What other challenges do you face when you're evaluating creditworthiness or structuring loans for these small businesses?
I'll give you a practical example. You'll see a well-to-do business, MSME. Statistics have shown that over 39 million businesses are MSME, and just 5% are able to access credit facility. So if you look at the structure, the entire MSME segment, the key and critical factor we'll look at for is that we'll be able to say that, okay, does this customer have the necessary credit stability or consumer stability, or you see, does this customer have all the necessary ingredients to be able to, for me as a lender, to give him the necessary facility. For instance, a customer requesting for, let's say, a facility of 50 million, because that fits into the SME segment, right? Yeah. And if you look at his turnover, probably you look at the consumer behavior and all the necessary parameters attributed to that customer. He may not necessarily have the collateral structure that will be needed to secure that. The cash flow projection, you see that through his cash flow or the necessary transactions based on the data applicable to the customer, his bank statement, you see that he's unable to meet the expected repayment that is accrued to that particular facility, 50 million. By such doing, I won't be able to lend from a lender's perspective. However, one of the key things I speak to SMEs, MSMEs especially, is that it's so important for them to do a proper bookkeeping, put the necessary structures in place, because through that, I'm able to see beyond the fact that this is what your request. I'm able to see that you've had the discipline to access such credit. I've seen that you'll be able to have the discipline to say, I see on a monthly basis, I see that this is what your business is doing based on the track record. Then I'll be able to have that confidence to say, okay, based on this, I should be able to lend to you as an SME.
Awesome. So digital credit scoring is is gaining traction, especially among fintechs. But I'm curious, how do you, I guess, traditional lenders now, like FSDH, how are you guys looking at this? Is this something you're already using or something you intend to use very soon?
Okay, so for FSDH, just to as well add a bit, right, what we're doing in the MSME space, part of what we have developed, I think we developed a product recently to be able to meet and address the need of MSME. We understand that they don't have the audited financials, but one thing that is critical is their bank statements could speak a lot. And that's making reference to the data. So part of what we've developed a solution in which we're able to analyze based on your bank statements to be able to say, okay, based on this, we understand that they are not yet, your financials are not audited like the medium and large scale businesses, but we pay attention to your transaction history. And through such, we'll be able to partner with some few fintech startups and other digital-driven organizations to be able to use their platform, leverage on that, to be able to analyze the history of our various clients, and we'll be able to lend to them.
Okay.
On that,
so a key piece of just improving the credit environment is regulation and policy. What kind of policies, what kind of regulations do you maybe, I guess, expect from the government to make it easier for lenders?
Okay, I think one of the most recent is the open banking API. And that's part of what is at least the CBN, because they are the regulatory body that plays around this, right, and guide us. So there's the open banking API, and what does that do? It helps us to utilize data of customer behavior across its banks, and through that we are able to generate, unlike the traditional banking credit appraisal, whereby you just need to bring all the documents, the audited financial and co. You are able to utilize that. I think very soon to be implemented. It was a bill that was passed. I think in the early 2020s thereabout. So it's part of the conversation that is being had, whereby it's going to be an open banking API, whereby you can interact with, based on consent. Consent is key. Based on consent, you're able to interact with the customers' activities across all banks, and based on that, you're able to generate data and be able to analyze, and through such, you're able to give that such MSME clients, credits on that. So yes, it's happening. It's something that is different. And even in FSDH, we've been able to develop a solution in which we target the SME segment, and we understand that these customers, they have daily transactions. So we understand that they have high volumes in turnover. However, a typical bank may not necessarily want to lend to them because they don't have an audited financial. So we have in business banking, we have a solution, a product in such a way that you're able to develop, you're able to use such customer transaction, his consumer behavior, that particular consumer behavior, and you'll analyze his data, you analyze his transaction counts and other stuff. And through such, you'll be able to see, based on the credits score, you say, oh, I know this person qualifies, and we're able to lend to him at at a very interesting rate anyways. So
Okay.
yes, we have such products in FSDH.
All right. So what are practices you see in a small business, and then you're more confident about giving them debt?
Practices.
Yeah.
So number one, first of all, I'll consider that the business is structured. You see a lot of businesses and they are not structured. If you look at through their pyramid, it's just half a sad. Their businesses, you need to have a structured business, and that's so important and critical to every lender, because they want to see that I want to develop confidence in your business. So I need to see that there's a proper structure in place. When I talk about structure, bookkeeping, very critical. You see some MSMEs, and why they are not even accessing facilities, because they don't have the proper records. They can't even say, okay, on a monthly basis, the record, this is how I've been able to utilize the sales that have come to me. Their costs of goods or maybe expenses. You see, it is not uniformed. So that's a challenge. So it's so important for businesses to be structured and ensure records are well kept. That's one. Two, you need to look at, part of what we look at in lending is we look at the history of the customer. That's the character, speaking to the character. Is this particular customer able to make repayment as I went to? So there are various credit checks that have been done, and you see that probably this customer have collected loan from XYZ and he has not made repayment in time past. That speaks to your behavior as a consumer, right, of our facility. You speak to your behavior. You don't make necessary repayment. You don't make necessary as at when due. That's the challenge. It doesn't speak well of your character. So it's so important for MSMEs to understand that it's necessary to make repayments as at when due. That's part of the factors I will speak to. If I would look at another addition is probably to data-driven, right? It will just happen to be in a situation whereby there's no adequate data that can speak to segments in the MSME sector. For instance, if I go to a sector, maybe the agri sector, the agri space, and you realize that, yes, you see a typical mama, maybe a business XYZ in a certain situation, they've been there for over 3, 4, 5 years, and they've been having sales, but you see the customer does not have the adequate data. Most of the transactions are not done via an identifiable data platform whereby you can say, okay, through this, I'm able to look at the transaction flow. So it's so important that even the MSA begin to adopt digitized platforms for their transactions, because through such, with where we are going to, many lenders will want to be utilizing data to also lend to various clients. So I think that's also critical. Data-driven businesses will attract, in fact, data-driven businesses will attract lenders I think in large instances, most data-driven organizations, MSMEs, will attract we as lenders in accessing facilities.
Awesome. That's a wrap for this edition of Equity Merchants. If you enjoyed today's show, subscribe on Business Front TV for full episodes and catch our clip highlights on LinkedIn and X. I'm Chimgozrim. See you next week when we dig into Sukuk bonds and why everyone is making such a big deal out of it. We might even take a closer look at the Nairobi Stock Exchange. Until then, keep turning capital into opportunity.